Now, everyone's well familiar with the Schwab US Dividend Equity ETF, or at least most people are, especially if you're a regular viewer of my videos here. You'll know that I talk about the Schwab US Dividend Equity ETF, or ticker symbol SCHD, a decent bit. And there's good reason for that. You know, it has a near 4% dividend yield, which is one of the highest long dividend growth ETFs out there. And it combines that with a very low 0.06% expense ratio, well diversified across over 100 blue chip dividend growth stocks. So it's got good diversification across a number of sectors, has a very impressive dividend growth track record over the past 10 years of nearly an 11% CAGR. That's incredible. And so when you combine that attractive current yield with that outsized dividend growth over the long term, the diversification, the low expense ratio, what's not to like? Sure, SCHD has a lot going for it, but there are other funds that have some strengths relative to SCHD. And in fact, SCHD does have some flaws. Namely, it lacks exposure to certain sectors, including REITs, has basically no exposure there, hardly any exposure to infrastructure and utilities, hardly any exposure to BDCs, has very little to no exposure to mega cap technology stocks. And so, you know, those are some glaring weaknesses that many investors want in a fund. And additionally, if it were to invest more in REITs, BDCs, infrastructure, AMLPs, utilities, etc., it would likely have a higher dividend yield, even higher than it does today. Now, it may have a slightly lower dividend growth rate, but somewhat more of that current income. Additionally, without the mega cap tech stocks, SCHD has dramatically underperformed the S&P 500 and many other indexes and funds in recent years, as it has been a bit of a dog from a total return perspective in recent years. And that's caused many to lose faith in it. They've dumped it and gone on up to other things, which is a pity because it's a great dividend growth story. Between the attractive yield and the dividend growth, investors are chasing returns in the short term, chasing the hot stocks, and abandoning the long proven road to wealth through dividend growth. And so, you know, I don't think people who are on the SCHD path should just jump ship and chase after returns elsewhere, because returns come and go year to year with different sectors getting hot and others coming in and out of fashion. But that dividend growth income is dependable and compounds over the long term. That being said, I also agree that SCHD can be improved upon. In fact, I don't own any SCHD myself. I pick my own individual stocks because I've learned through my own experience and through just my own study of how investing works that you can further accelerate the compounding process through intelligent active management of a portfolio, recycling capital regularly. And that's why I've been able to more than double the performance of SCHD ever since I launched my portfolio at High Yield Investor almost 5 years ago now. And so that's the approach I take. It's working well for me, and I don't plan on changing it. But for investors who want to take a more passive approach, I think SCHD is a great option as well. Now, with that being said, in this video, I'm going to talk about another ETF that actually tries to improve on a lot of the flaws that SCHD does to give investors a little bit the best of everything out there. And it's ticker symbol DIVO. I'm going to talk about that in this video and why I think that DIVO perhaps could be a good substitute or even a supplement to SCHD. Before I get into the rest of the video though, if you like regular content on dividend ETFs, individual dividend stocks, dividend portfolios, dividend investing strategies, and more, please subscribe to this channel. It would mean a lot to me. I'm the leader of the top-rated investment group on Seeking Alpha, High Yield Investor. And so if you want even more insight into how to put together a dividend portfolio that not only generates attractive and sustainable and growing income, but also through implementing an opportunistic capital recycling strategy, you can generate market-crushing total returns over time. I encourage you to check us out at High Yield Investor. The information with the link to it is in the video description. Thank you very much. Now on to the rest of the video. So let's talk about DIVO and what sets it apart from SCHD and potentially makes it better. Well, it is like SCHD in that it does focus on a lot of high quality dividend growth stocks. But that's really where the similarities end. DIVO is actively managed. So like I just said, I like actively managing my own portfolio and been able to do a lot better than SCHD. By doing that, the managers of DIVO feel the same. And over time, they have outperformed SCHD. Not by a lot, but they have outperformed it. And so there's something to be said for their active management. Now, in exchange for that active management, you are paying a higher expense ratio of over 0.5%, which is significantly higher than SCHD's paltry 0.06% expense ratio. But again, their total returns are net of that expense, and they've still outperformed SCHD over time. So you can't knock them for that. They're clearly earning their expense ratio that they charge. That being said, you are taking on enhanced risk to do this. They only have 30 holdings and have over 50% of their portfolio concentrated in their top 10 holdings, whereas SCHD has over 100 individual holdings. And so you get much greater diversification with SCHD, but also a little bit weaker performance. So what are you looking for there? DIVO also seeks to improve upon SCHD's dividend yield. They offer a higher dividend yield at the moment than SCHD does. Not a lot, but it's almost 100 basis points higher. So you are getting a better yield from DIVO. A big reason why DIVO has outperformed SCHD recently, and you could say a big improvement that DIVO offers, is that because of their active management, they're able to be more flexible in what they buy. That includes potentially some mega cap tech stocks, and they have this in their portfolio. Some of their top holdings are mega cap technology stocks. Now, they're constantly recycling capital, moving to different positions, so these change over time, but they do make a priority of investing in some of these truly wonderful world-leading companies. Now, you may say, well, that's great, but those stocks generally don't yield much of anything in the way of dividends. How are they still to have a higher yield than SCHD? What's the catch here? There's no free lunch. Well, they try to bridge that gap through selling calls. And so you could say that, oh, well, okay, they're just like a JEPQ or JEPI or QQQI or SPYI or one of these other covered call funds. So why not just buy those instead? Well, the key here is that, for one, they have a lower expense ratio than some of those funds like QQQI and SPYI, which are also somewhat actively managed. And the more passively managed ones like JEPQ and JEPI, albeit they're not entirely passively managed, they do have a little bit lower expense ratio of 0.35 than DIVO does. But DIVO, again, tries to implement the best of both worlds. It gives you a lower cost fund than the actively managed covered calls out there, while actually giving you truly active management of the covered call strategy as opposed to JEPQ or JEPI. And so they only opportunistically sell covered calls when they think that the risk reward is attractive, and when, based on their internal valuation analysis and maybe perhaps technical analysis, whatever else they do, they decide, hey, this is a good individual stock. They don't sell on the whole portfolio. They just sell on certain holdings that they have that they think, okay, there's an attractive options premium relative to the valuation here for this stock, not for this one, et cetera, et cetera. And so they do that opportunistically to generate enhanced yield, to support that higher dividend payout, and to ideally create total return alpha over time, but not putting themselves where they're capping a stock that they think there's high upside potential in the near future, and thereby setting themselves back. Now, of course, no one is perfect. They don't implement the strategy perfectly, hence why they don't deliver incredible total returns. But again, their outperformance of SCHD indicates that there are at least some merits to their strategy, and so it's worth looking at. And so, in that sense, DIVO, you could say, is a best of both worlds synergy between, say, JEPQ or JEPI and SCHD. And so a lot of investors like that. They like that one-stop shop. They like that there's active management that's working on their behalf, that has a pretty good track record. And hey, I don't disagree. And so in that sense, I think DIVO would be a better pick if you just want a one-stop shop with active management that you can sleep well at night knowing that they know what they're doing to a pretty good degree. That being said, there's still some shortcomings with DIVO that I think make SCHD and perhaps a supplemental holdings with, say, JEPQ and maybe some other stocks that make it not so great. First of all, the yield is not that much greater than SCHD. And so if you supplement SCHD with JEPQ and perhaps some MLPs and some BDCs and some REITs or utilities or infrastructure stocks, you can get a much better weighted aggregate yield through the other option. Additionally, DIVO's dividend growth rate is really not that great. In recent years, it's only about 3 to 4% per year, way behind SCHD's. And so again, if you supplement SCHD with some of these other stocks out there that actually also have pretty strong growth rates, you can end up doing much better, both in terms of current yield and dividend growth in aggregate, following those other options rather than just following investing in DIVO. So again, that may make a little more work on your part. It's not a one-stop shop, but I think if your goal is yield plus dividend growth, you can do better than DIVO. Now, again, if you just like the hybrid positioning there and you don't want to give a lot of time and effort to your portfolio and you trust management there for DIVO to deliver outperformance over time, okay, it can make sense, especially with a simplified one-stop shop. But otherwise, I think you're better rolling up your sleeves, doing some active management, either entirely in your individual stock portfolio like I do, or use SCHD as a core, perhaps supplement it with JEPQ or JEPI, and then maybe sprinkle in a few other holdings that you pick, whether they be ETFs, CEFs, or individual stocks from some of these other real asset sectors that can give you a higher yield, along with dividend growth rates that should be roughly on par with DIVOs anyway. So there you have it. Hope you liked this video. Hope it gave you a better perspective on the strengths and weaknesses of funds like SCHD, DIVO, JEPQ, JEPI, and how you can mix and match them together to better meet your individual dividend investing needs. If you like this content, again, please subscribe to the channel, give the video a like to help it get better distribution out there. It would mean a lot to me. Thank you so much. See you next time.